Hey everyone, and welcome to this explainer on the Federal Reserve's June 2026 decision to freeze interest rates. Look, we're going to jump right in today because we need to outline exactly how you can stop losing money and start protecting your wealth right now. If you don't fully grasp what this freeze means for your wallet, you could literally be losing hundreds, maybe even thousands of dollars without even realizing it. But hey, don't worry, you absolutely do not need an economics degree for this. We are going to break the whole thing down in plain, everyday English. To kick things off, we are diving straight into a massive number, $1.25 trillion. That is the credit card debt crisis currently gripping American households, and it is exactly why you urgently need an action plan. With rates frozen at these high levels, managing your debt, especially credit card debt, is the absolute most critical survival tactic you can deploy right now. I mean, 1.25 trillion isn't just some abstract macroeconomic statistic, right? It represents a crushing burden on everyday people. So we are going to focus heavily today on how you can navigate this high-interest environment and finally stop the financial bleeding. So here is our financial triage survival guide for today's explainer. First, we'll cover the 2026 rate freeze. Second, stop credit card wealth destruction. Third, navigating mortgages and autos. Fourth, high-yield defensive moves. And finally, we'll wrap up with 5 high-rate money moves. All right, let's get into Section 1, the 2026 rate freeze. Okay, so to really understand the freeze, you first kind of have to understand the federal funds rate. The Federal Reserve is America's central bank, basically the most powerful financial institution in the country. Their main job? Control inflation and keep the economy stable. Now, the federal funds rate is the primary lever they use to make borrowing more or less expensive for, well, everyone. When they raise it, everything from a home mortgage to a small business loan gets more expensive. When they cut it, borrowing gets cheaper. But when they hold it steady, like they just did in June 2026, they're sending a very loud, very specific message. Inflation is simply still too high to cut rates, but the economy isn't weak enough to need a boost. So why did they hit the pause button instead of cutting? Well, the central bank froze rates because the consumer price index is still running hot at 3.8% for the 12 months through April 2026. And a lot of that is driven heavily by energy prices, which are up a staggering 28.4%, and food prices up 3.2%. They're trying to weigh their ideal 2% target against these red-hot costs for everyday essentials. And because 3.8% is still so far above their target, they just cannot afford to make borrowing cheaper yet. Lower rates would encourage more borrowing and more spending, which just throws fuel on the inflation fire. The big takeaway for us, high rates are sticking around, and that completely changes the game for your debt. Which brings us to Section 2, and honestly, the most urgent part of this whole explainer. Stop credit card wealth destruction. This right here is the really bad news of the rate freeze. Because credit card interest rates are tied directly to the Fed rate, credit card APRs are sitting near record highs of 21 to 29%. If you are part of that $1.25 trillion debt statistic we talked about earlier, and you're carrying a balance right now, you are paying that massive interest penalty every single month. Let's be crystal clear about what this is. It is wealth destruction. It's not just a fee, it is actively wiping out your financial progress. So the absolutely crucial point here is that attacking this credit card debt immediately has to be your highest priority. Look at it this way. Paying off a 24% APR credit card is mathematically identical to earning a massive 24% guaranteed return on your money. Just think about that for a second. There is literally no investment in the world that can offer you a guaranteed risk-free 24% return. None. Your absolute #1 survival tactic in a high-interest environment like this is to attack your credit card debt with everything you've got. Moving on to Section 3, navigating mortgages and autos. All right, so mortgage rates are also heavily influenced by the Fed, and right now they're sitting between 6.5 and 7.2% for a 30-year fixed, obviously depending on your credit score. Since rates aren't getting cheaper anytime soon, you need a solid strategy. Do not try to time the market waiting for rate drops that just aren't guaranteed. If you find the right home at the right price, buy it now, and you can always refinance later if rates eventually drop. Now, if you already own your home, the move is to sit tight. Only look into refinancing right now if your current rate is somehow above 7.5% and you plan to stay in the house long term. Now let's talk cars. $13,000. That is what a standard $40,000 new car loan at 10% for 6 years will cost you in interest alone. Just the interest. Auto loans have peaked between 7.5 and 14%, which is the highest we've seen in over a decade. That is simply your hard-earned money evaporating into thin air just to service debt.
Because car debt is so insanely expensive right now, your auto loan survival tactics have to be super defensive. First off, if you can wait to buy a vehicle, just wait. Hold off. If you absolutely must buy in this environment, protect yourself. Consider a used car bought in cash. If you absolutely have to finance, please avoid financing a brand new car for 72 months. Take out a smaller loan and put down the absolute largest down payment possible. You have to minimize the loan amount to avoid that crushing interest.
Okay, let's flip the script to Section 4, High-Yield Defensive Moves. There is actually one genuinely good thing about this rate freeze. High-yield savings accounts are currently paying 4.5 to 5% guaranteed annual interest. Guys, this is a massive upgrade. If you still have your emergency fund sitting in a traditional legacy bank account earning like 0.01%, you are literally leaving free money on the table every single day. To put that into perspective, on a $10,000 balance, moving your money to an account paying 5% earns you an extra $490 a year for literally zero extra work. It's a no-brainer. Furthermore, you absolutely must maintain your investing discipline. High interest rates do not mean you should stop investing. Actually, scratch that. History shows the stock market can still deliver really positive returns during high-rate periods, and the S&P 500 has continued to perform strongly in 2026. So keep consistently investing your money into index funds. Do not pause those Roth IRA contributions, and whatever you do, don't try to time the market. Consistently dollar cost average into broad market index funds like VTI or VOO. And hey, if you've managed to clear out that high-interest credit card debt we talked about earlier, this is actually a fantastic time to increase those investment contributions. Let's bring it all together now in Section 5, 5 high-rate money moves. Based on everything we've covered, here are your 5 exact money moves for this week. Move 1, maximize your savings yield. Get that cash into a 4.5 to 5% high-yield savings account today. Move 2, and I cannot stress this enough, this is the most critical, ruthlessly eliminate your credit card debt. Treat that 21 to 29% interest like the wealth destroyer it is. Move 3, lock in necessary mortgages if you're buying within 6 months. Do not sit around waiting for magical rate cuts. Move 4, keep investing consistently in index funds because time in the market always beats timing the market. And move 5, fortify your financial foundation by building a 6-month emergency fund in that high-yield account so you can weather any economic uncertainty coming our way. Most economists are predicting potential rate cuts maybe late in 2026, like September or December. But remember, those are just predictions, not guarantees. The people who actually win financially, they make smart moves based on current reality, not future hopes. Don't wait for the Fed to come rescue your finances. Attack your debt aggressively right now. So take a look at your own situation. How is this high interest rate environment affecting your finances right now? And out of these 5 survival moves, which one are you going to execute first?